All right, so I'm going to assume there's not a ton of knowledge about commercial leasing, so I'll start pretty basic, and then we can get into more and more depth as we go through it. I'll stop a couple times for Q&A, so feel free to either type it in the chat box or we can unmute you and let you ask the question live. So, first I want to just comment that one, there's no such thing as a standard lease. You might hear people talk about it in my industry as using the standard form. It's never standard. It's always customized. There's almost always exhibits that go with it that really clarify, who's responsible for what and how much it's going to cost and all these other things. And I've seen them from, 6-7 pages long to 500 pages long. Hopefully, you all are not giant corporations and you're not the 500-page lease people, but still, they're complicated and they're incredibly critical to get right because it's going to define everything about your relationship with the landlord in the future. Purchases are somewhat more straightforward. Purchase agreements are usually a little more, they're simpler, they're less moving parts typically, but leases are extremely complicated. So getting some great advice, whether it's from a commercial broker to start with, an attorney, tax advisor, et cetera, it's very important. Can't stress that enough. And, not everybody knows much about commercial leasing and some might think it's simpler than purchasing. But I'll tell you that, generally when you're leasing something, a landlord's looking at this almost as if they're selling you the property for a period of time. And they want to know that you're creditworthy. They might ask for proof of funds. They might ask for a personal guarantee. There's a lot that goes into it. Not always, but I'd say most of the time. So I'm going to share my screen and go through a slide deck with you all. So just bear with me for 1 second. So we'll kind of get started with the lease side of things and when it makes sense to lease. And I think the biggest thought is that when your cash isn't abundant, you don't have enough for a down payment, maybe leasing makes more sense. It's not the only reason, but it's one of them. That can be true if you're trying to lease something that's already set up pretty much the way you want it. It's got the right carpet or flooring and it's painted the right way and the walls are in the right place and all that stuff. That can be a huge savings to you versus purchasing. Generally speaking, though, there's a lot of money that goes into lease space. Sometimes that's shared with a landlord. Sometimes it's entirely on the tenant, but it can be very expensive to upfit a commercial space. So keep that in mind when we're going through the rest of the program. And sometimes the landlord will finance it for you. And what that means is they'll probably build it into the lease rate for the first 2-3 years and just make you pay a much higher lease rate per month. But it might be very helpful to you to do that because you don't have necessarily a pile of cash and you can afford the rent as your business gets going, even if it's higher for 2 or 3 years. And the cash that you're going to want to make sure you're protecting yourself for, what do you need for your business operations, inventory, marketing budget, the space improvements, which we already talked about. And, if cash just simply isn't available for down payment and you happen to find that perfect property that's already set up for you, then it makes all the sense in the world to go ahead and lease. If purchasing isn't an option, that could be the cash issue, but it also could be that there are no properties where you want to be, or where you want to be, there's only one and it's offered for lease. And that happens more than you'd think. Our economy is still quite good in commercial real estate, even though leasing is down because of COVID. It's still kind of tough to find space where you want it and how big you want it and the price you can afford and all that other good stuff. So we'll kind of go through some benefits and pitfalls of leasing. Start with the benefits. Flexibility is usually what people say is their number one reason for leasing, and flexibility could mean quite a few different things. Generally, I think what people think of is the term of the lease. If they don't want to commit a lot of resources to it, if they're unsure about their business, maybe it's a startup, you can always lease for a year or 2 years or some shorter period that you're comfortable with. And it also means you don't own the property and you're not stuck with it long term. The upfront cost, again, can be a benefit. If it's already set the way you want it, you might have huge savings there. And then tax treatment, the laws are always changing and evolving. It's getting to the point where I think leasing is starting to become a preferable way to manage a business. You can write off the entire cost of the lease and operating expense, but I am not a CPA, so you need to find somebody who is, or your financial advisor, to really decide what works for you based on your personal experience and needs. And then a sale leaseback. This is something that if you chose to buy something, you can always become a tenant again. You could sell it to somebody else and lease it back from that new person that owns it. Or if you're leasing a property, you need to keep in mind that you have now potentially boosted the value of that property by putting a lease on it, so that that landlord now could possibly sell it, which you're protected in your lease, but you also might have missed an opportunity to purchase it at a lower price if that was your dream, to own the space, because you might have significantly boosted the value just by your presence and the terms of your lease. And I'll go through an example of that a little bit later on as to how that works and stuff to watch out for. So some of the pitfalls: obviously, you're not going to see any upside from appreciation over time. And that isn't really even a benefit of buying all the time either, because when you go to sell a property, you have no idea what the market conditions are going to be like. Chances are, over a long period, it's going to be good and you will see some appreciation. But there's a lot of factors that go into future value, especially on commercial real estate. Could be that part of the market physically, geographically, is no longer in favor, and people just aren't wanting to lease there, even though your property is perfectly good, it's in great shape. People just might not want to be in that part of town. Chances are good. Again, everything depends on the specifics, but chances are good you will be experiencing higher monthly payments, and you're not paying yourself, you're paying a landlord. There's little or no control over the property. That means when it might be sold, or if they're, maybe they need to redo the parking lot and they're redoing it at the time that your business is on fire, especially in a tourist town like us. Why would you do that during the summer? Well, you have no control over that if you are just the tenant. Again, unless it's part of your lease. And again, if you're spending a bunch of your own cash upfitting your property, sorry about that, that's somebody else's property, especially if you only want to sign up for a couple years. You're really not protected there at all. So let's shift over to buying for a second, unless anybody has any questions. Morgan, can you see anybody in the chat room?
It looks like we're good on questions right now, Mark.
Okay, well then I'll just keep rolling. So purchasing, the benefits are oftentimes somewhat obvious, but I'll just kind of say a lot of them are the opposite of the lease pitfalls, but they're not always crystal clear. It depends on how long you're going to occupy the property. And there's typically a break-even point after X number of years when owning the property makes way more sense than leasing it. And that could depend greatly. It could be at 3 years or 7 years or 9 years. But typically there's a level where it probably makes more sense to buy it. Again, that's something you'd want to review with your CPA or tax professional. And the other thing about buying it is you can always convert it back, and you could sell it off probably at a premium if you're willing to stay, sign a long-term lease. And by long-term, I'm usually meaning 7, 10, 12, 15 years, something like that. And depending on your business, if you've been doing your business for a long time and your company's really solid, you would avoid any personal guarantees on that lease. Your company would guarantee it. And you also would be viewed as somebody who's a great tenant, and people are willing to pay more for that. So you might be able to get a cash infusion to grow, to get another location, to buy equipment, that sort of thing, by converting something you own back into a leased property. So some of the pitfalls in buying, again, it's down payment and property improvements you might need to make. It can be a little bit harder to expand. So if you're starting out, maybe you're new and you're starting out a business and you don't need a ton of space at first. If you own, say, a freestanding property or even an office condo or something like that, you may have a physical limitation to how big you can build the space out. It could be that the setbacks on either side of you and behind you don't allow you to expand at all, or maybe you'd have to go up a floor and that's not really what you want. So sometimes leasing can be better from that perspective. If you think about a retail center, you you might be able to take the unit next door. When that tenant maybe moves on, maybe you could double your space and stay put and not have to, re-educate your client base that you moved. So that's not always the best thing with buying. And again, people think that sometimes when they buy a property, well, that's their nest egg. They'll keep it for 20 years, and when they're ready to retire, they can sell it and they're going to make a ton of money because, appreciation over time. And while that's somewhat true, we touched on that a minute ago, that market conditions drive that. If you had done this back in the crash of 2008 and you wanted to retire, it took Wilmington until about 2014 to really recover in real estate values. And not to mention, certain parts of town are just not as favorable as others anymore. So it's not always something to bank on. And that's another reason to consider a sale leaseback if you ever did own something. While the property's in great condition, while the location's still great, it might be a good time to do a sale leaseback. And of course, there are capital costs. By the time your building's 20 years old, you probably have needed a new roof, and you might need new siding. You might have all kinds of issues crop up that you're spending a lot of money on, and it eats into whatever return you're going to see. So again, I'll pause for any questions. Okay, well, I'll move on. It's going to be a quick seminar, I think, without any questions. So the way you can really decide whether it makes more sense to lease or to own is to plug it into some of the various programs that are out there. There are some free ones online. They're not great. CCIM, which is kind of the gold standard for commercial real estate certifications. It's a certified commercial investment member is what it stands for. But basically, they do a ton of training on financial modeling, and they have some good tools there. And then, of course, your CPA or tax accountant could also help run these things for you. Bottom line, though, is if you're trying to do this yourself, you better understand it and understand what the inputs are and what makes sense for you as a person, what your opportunity costs for going into something versus something else, whether you're purchasing or leasing. And honestly, commercial real estate brokers are pretty much free. At least at first we are. We give a lot of advice out for nothing. We've all seen hundreds or thousands of leases and sales transactions. So we really have a broad base of knowledge to help guide you. We're not attorneys, and that would be the next step, is find, first a CPA or tax advisor for the financial side. And then once you decide what you want to do, you need to get an attorney to be able to review your lease or your sales contract thoroughly. So at the end of the day, what you're going to find out is just like what we said before. The less time you plan to stay somewhere makes more sense to lease. The longer probably makes more sense to buy. But there are a ton of moving parts. I'm going to pull up a example of how these calculations go. So again, just bear with me for a second. I think it's here. So this is one that anybody can purchase. It's a few $100 a year to use, or about $50 a month, I think, if you don't want to commit to a year. But anyway, if you're really going to consider leasing versus owning, and you're just starting the process, and it might take you several months to get there, it might be worth investing in something like this. But these are very limited models. So let me just walk through kind of how the inputs work and how you'd want to digest it. So I plugged in a bunch of this information that you can see, and you will start in the lease section under year annual rent. And I put in $70,000 for annual rent there. What that is based on is a ballpark of a 3,300 square foot unit, whether it's retail, office, doesn't matter. And I assumed $21 a square foot. And I assumed triple net expense treatment, which means the tenant is paying for property taxes, property insurance, and common area maintenance on top of utilities and other things that they might normally pay for. So I just pulled this out of my ear, but I think it'll be a decent example. The rent escalator, I put in 2%. I would say that that's on the low side these days. I think CPI, or the Consumer Price Index, over the last 15, 18 years is more like 2.5%, and landlords want to stay ahead of that. So you'll probably see this increase to 3%. I've even seen it be as high as 4%. But there's also a lot of flexibility on how that works. You could have a flat rent rate for 5 years and then a 10% increase at the end of those first 5 years. It still averages out to a couple percent a year, but it might make you more comfortable to plan out your expenses. And the annual expenses, I just took a stab at what is about what I'm seeing out there in the marketplace of $13,000, and that is your additional taxes, insurance, and common area maintenance, or TICAM.
Mark, sorry to interrupt. This is Morgan, but I just want to make sure that we are seeing the correct view. We're still looking at the detailed analysis slide on your PowerPoint, and it sounds like we need to see something that has some figures on it.
That is correct. I don't know why it's stuck on that. New share. Let me try this. Hang on.
That looks great.
Okay. I'm still new at this. Okay. You're seeing what I'm talking about now?
Yes, it's perfect.
Great. So the lease side, I just kind of ran through. There's your 70,000, your escalators, and your annual expenses. And then on the flip side, what could you buy this thing for? Well, I assume the same property, about 3,300 square feet. I think I came up with 150 a square foot ballpark. That got me to $500,000. I put in annual expenses. That's probably pretty high, but there are annual expenses. And in this case, you are paying your own. If you're occupying your own building and you're not leasing it to somebody else, you're paying your own taxes, insurance, common area maintenance, probably some capital costs here and there. And you now have a down payment requirement. We used $100,000, so your loan amount would be 400 grand. Your loan rate at 4.5% interest, that's probably not too far off of what it would be. And in commercial loans, if you've done a home before, you know that it's generally a 30-year fixed or an ARM, adjusted rate mortgage. In commercial, it's different. There's usually an initial term that's much shorter than the amortization period. So in this case, it doesn't say this, but I would guess it's a 5-year, 20-year amortizations, meaning your payments are based on 20 years, but your loan will mature in 5 years or 7 years or 10 years. And so there's a balloon payment at the end of that period where you're going to owe the balance, or you just refinance and just do another 7-year, 20 am or 30 am loan. So if we continue on with this, there is the after-tax discount rate. That means a lot of different things to different people. A big corporation would look at this very differently than an individual who's buying it for their own purposes. Really what it comes down to for most people is what's your opportunity cost? If you believe you can earn 11% on some other investment, whatever that might be, stock market or a different building or whatever, then you would want to put this at 11% because that's your minimum required return basically. So in this case, I think in general, you'll see a lot of 5, 6, 7% discount rates used for modeling. But again, it just depends on your personal opportunities outside of this specific purchase you're considering making. So again, that's for your CPA and financial advisor to help you with. What then we can change are some of these default settings. And first, we're going to do commercial. I put in a relatively low marginal tax rate. Capital gains on a property this size, once you decide to sell it, would be more like 15%. If it's above a certain dollar amount, then it goes to 20%. Cost recovery tax rate, that's again a CPA sort of thing, but I left the default in at 25%. Annual property appreciation, we're going to say is 3% a year. Your expenses will also go up by 3% a year. Cost of sale on disposition at 5% of the sale price, that's not too far off. That's going to be real estate commissions. It's going to be paying an attorney, title company, et cetera, to get it closed. And for now, I'm just going to say there's no percent of the purchase price that you're going to put into improvements, just to make this a little bit simpler. But that could be 15% of the purchase price, 10%. It just depends on what you need to do to the building to make it work for you. So again, you can change all that stuff. And if we generate the report, and I'm hoping you're seeing that.
Yes, looks great.
Okay, great. So it gives you your summary. It basically is saying the net present value. So this all incorporates the time value of money. So $1 you spend today is valued differently than $1 you'd spend 5 years from now. And it calculates all of that based on the inputs we just talked about. So the net present value of a purchase is 210,000. It's a negative number there because these are outlays, net outlays. And then the net present value of a lease is 256,000. So in this case, it's telling you that with a 5-year hold, which is what this program allows you to do, with a 5-year hold, it's still probably better to purchase than to lease. And this IRR, which is an internal rate of return, that is saying that the difference here, this 46,000, is worth about 15% to you as an investor versus leasing it. Internal rate of return calculates when you spend money. The down payment is in year 0 typically, and then your cash outlays for expenses and mortgage payments as they flow over time are valued differently because of the time value of money. So it's a little more sophisticated than just a simple, ROI, return on investment. This also goes into the projected sale price. So it's assuming it did appreciate 4 or 5 years at 3% a year. So that means you could sell your $500,000 property for $580,000. This 29,000 should reflect about the 5% cost of sale number. The mortgage balance at this point after interest and principal payments should be about 330,000. You saved on some taxes of about 7. So your net proceeds after tax are $200,000. So again, you're making money on this versus just putting your money into a lease. Now, I don't like this form because a 5-year hold is about the minimum most folks would be looking at if they're purchasing something. So if you were to spread this out over time, you would probably see that purchase return is going to be way higher than the lease. And conversely, if I could edit this down to 2 years or 3 years, you're going to start to see that the lease is going to make a lot more sense. So I'm not going to go through the rest of this form in detail, but just know that you're going to get some pretty detailed information. So again, if you're buying it in year 0, there's a $100,000 down payment. These are your mortgage and expense payments. And then if there were improvements that you could take as a write-off and other things that would go into this column here, there'd be an additional column where it would illustrate that. And then it shows your return here at 212,000 at the end of ownership when you sell. And it feeds what was up above that we already talked about. Here are all the assumptions that we talked about as well. So it gives you kind of a nice side-by-side, and I think you can go from there and feel pretty confident that you're making a good, well thought out decision. Does anybody have any questions on this part?
And just a reminder to put your questions in the chat, and we will pull you in to answer, or for Mark to answer them directly.
Yep. And I'm going to share my screen again. Maybe.
And it looks like we are back on your PowerPoint, Mark.
You are? Okay,
Yes.
good. So that worked that time. Except that I can't see the mouse anymore. That's fantastic. Is all that you see is the PowerPoint?
Yes, so the
Okay.
slide says doing both lease and own. And then we
Okay.
see your first bullet point there.
Okay, well, my screen is not helping me, and I don't know how to get out of it. All right, well, I'll wing it because that's what we do in commercial real estate. So let me just flip to my own paper version so I can talk correctly. You can see it, but I can't. So yeah, there are many things to discuss here that are just words to the wise and how commercial real estate can work, and it's not always nice. The one thing you can do in a lease, if you chose to go that way, is to get a right of first refusal, or ROFR. Okay, that basically just says that if a third party comes along and makes an offer to the landlord to purchase the building, if it's a bona fide offer, generally in writing, that landlord then must give you the opportunity to match the terms of that new purchase agreement. And you will have usually 15 days or 30 days to make that decision. And typically a landlord will also include in your lease that you would be required in this right of first refusal to close within about 30 days or 45 days after you notify them that, yes, you want to go ahead and match that offer. If they screw up and don't put that in there, then you can actually go with the terms of that offer, which might be 6 months of due diligence period where you can get all your earnest money deposit back. You know, it's complicated. It needs to be written properly to protect everybody. One of the problems with a right of first refusal that people don't quite grasp is, and I'll use a real world example. I put a tenant into a building with a long-term lease on it. They chose not to buy it. They were offered to purchase it at about $500,000. They put a ton of money into fixing up the property, and they put in a ton of equipment, very expensive, difficult to move equipment. And they signed a 10-year lease term. Well, what did they do to the value of that property? Well, they just increased it massively because of the quality of their lease, the term of it, as well as they improved the building itself on their own dime. So that's all great, but about, I think it was 2 years later, there was a bona fide third party offer on this property, and it was at $750,000. And so they basically sort of lost $250,000 in the course of 2 years because of the quality of a tenant that they were. So they did the right thing for themselves because the equipment they needed to buy was so expensive that they just didn't really have a choice. But it's just something to think about down the road. The next one would be lease with an option to purchase. This one is, most of the risk is going on the part of the landlord, but you as the tenant would be required to purchase an option. There's no set number to that. It's just whatever you would agree to, but it's not nothing. And it's a non-refundable fee typically. So it might be such that you buy a $500,000 building, you lease a $500,000 building, you have an option that you can buy it within the first 18 months at, $500,000, $525,000. And to get that right, so the landlord's now locked into a price for 18 months, they're going to want something for that. They might want 10,000, 20,000, but it won't be a really small number. Might be the right thing to do for you, especially if you just know you want to own that building and just can't handle it day one. And then once again, we've got the issue of a sale leaseback. One of the things about a sale leaseback, and I doubt very much that it would apply to the folks on the call today, but like a large medical practice, for example, if they wanted to sell their building and lease it back for 12, 15 years, there are institutional buyers out there that place funds for pension funds or for insurance funds, et cetera, just a lot of money in the market, and they'll pay top dollar for something like that. And so sometimes it can make a lot of sense for a physician group to do that. Leasing is a different tax treatment, so it just kind of makes sense. On top of that, the incentive to these physician groups can often be that they get to buy back into the building. So they could be a minority owner in the building. They wouldn't have any voting rights. They wouldn't have any control, but they would still get a percentage of their lease that they're paying out every month. Now that they're a tenant, they would get that back every month, whatever percent ownership they have. So it's a discount essentially to their lease. And they're sometimes granted the right to co-invest with that large investment group in other things or a larger portfolio. So not only do they own a piece of their building, if each of them, came out with $100,000 to do whatever they wanted with, they could put that $100,000 into a larger portfolio of medical properties that would be held for a few years and then packaged up as a $300 million sale sold. And the returns on that can be outstanding. I mean, truly 20, 30% annual returns on something like that. So it's super popular with that group. But again, I doubt very much that you guys would be doing something like that. But if you are, look me up. I'd be happy to help. So, the next steps, and I kind of touched on this stuff, is I would strongly recommend you find a commercial broker you're comfortable with and seems knowledgeable. And I underlined commercial because those of us who practice commercial real estate only, this is all we do. there's a certain level of quality you're getting. Most of the brokers in my firm have been engineers, CPAs, lawyers, senior people in Fortune 100 companies. These people know commercial real estate. They know numbers. They know how to analyze deals and really help you out. There are people that dabble in it. Residential real estate brokers sometimes will say that they can do commercial. Some can, most can't, and I would caution you to not go that route. So like I said, the initial consult is free up to a point, and typically any fees that are going to be paid are going to be paid by a landlord or a seller. Occasionally, a tenant might be asked to pay if it's an off-market deal and the owner of the property is just not interested in paying any commissions. Well, I don't work for free, and hopefully you don't either. And sometimes the tenant could be responsible for it, but that would all be spelled out up front, and it would often go into how you structure your proposal, whether it's a purchase or a lease, and you would net out whatever commission dollars are on hopefully a lower rent rate or a discount to the purchase price. You need to find a good real estate attorney. And just like you would want to find someone who does commercial real estate to be your broker, you want somebody who does real estate, preferably commercial real estate, in the practice of law. So if you have a great corporate attorney, that's wonderful for you. I would not suggest you use that same person for a real estate transaction. They often have somebody else in their firm that could handle it for you, but again, just get the right people lined up to help you. We do have some recommendations. Again, we do a lot of transactions every year and over the past 15 years. So we know a lot of the great attorneys in town. We're happy to give you 2 or 3 to talk to and interview and see what you think. And again, we sometimes can do, I don't want to say a better job than the attorney, because the legal language and the way it's crafted is so critically important. But some attorneys have done fewer deals. We've seen zillions of them. So we can sometimes spot where there's something just missing in a lease, for example, that is really in your benefit, whether you're the landlord or the tenant. So leverage your broker to really review those documents as well. They might find something that could help you out. And then, of course, talk to your CPA or your tax advisor to get all these analytical things done. You might end up with a commercial broker, especially if they're a CCIM, as I mentioned, that is very qualified to run some modeling for you. But we are not CPAs. We do not do this for a living all day long, every day. We don't keep up with changes in the law the way a CPA would have to, or a tax attorney would have to. So you gotta have that piece. It's worth the money. I promise you, it's worth the money. And the last piece of advice I would give, if you're signing a purchase agreement or you're signing a lease, you're going to do a lot of negotiation, most likely back and forth, hopefully with attorneys involved. And then you're going to get to the signing table. And depending on where you're doing the signing, if it's at a landlord's office or maybe it's an attorney's office, what I would do is read the entire document one more time, and every document that you're putting ink on. I have seen it. It's called slip sheeting. I've seen it done. It's illegal. It should have terrible consequences for whoever does it, but that's where they'll show you your document. They'll leave the room to go make copies for everybody. They'll come back. They have replaced one of the pages without you knowing about it, and you think it's the same thing, so you're happy to just initial every page, sign the back, and you're done. I can't stress enough, look through the document, every page, every time. And that's really all I got. This went pretty quick, but I'm more than happy to answer any questions, or if you don't have anything you want to talk about on this seminar, my contact information should be on the screen for you. Feel free to email me. I'm much easier to reach via email, and then we could set up a call. But it's mark.johnson@cbcsuncoast.com.
It looks
And
like
again, I'll open it up for any questions.
Yeah, we do have a question, Mark, from William. Okay. William wants to know if your presentation slides will be available and Excel sheets, and if so, where will they be available for download?
Tell you what, how many people do we have on here now, Morgan? I can't see.
It looks like we've got about 7 folks.
Okay, so there's so few people. If you would email me on the email address that I just put up there. I will just email them back to you. Be happy to share that. And I can even give you a link to where you can find some of the worksheets that I've used. Unless there's a way for me to post this on the Wilmington Biz site. Happy to do that too.
And just a reminder, if anybody has any detailed questions that they'd like to ask Mark, just let us know in chat and we'll be happy to enable your video so you can talk directly.
Yep, be happy to do that. And I know this was kind of cursory, but again, I don't know who's in the audience and what your sophistication level is. I'm happy to one-on-one go as deep as you want to go on any of these subjects. This is so weird doing this virtually. I miss getting up in front of a group of people. I can read the audience a little bit and we can actually get some good dialogue going. But hopefully it was useful to y'all. And I'm not trying to cut this short, but if there aren't any more questions, then I think we can go ahead and end the seminar. Morgan, anything I'm missing?
I think we've got it, Mark. We'll go ahead and end. Thanks so much.
All right. Thanks, everybody.